Money laundering. The methods, procedures, or processes used to transform unlawful cash obtained through criminal activity into assets while concealing their true source, so that the money looks to come from a legitimate or legal source. Stages of money laundering. Money laundering is divided into 3 stages. 1. Placement. 2. Layering. 3. Integration/extraction. Placement. Cash-based business, combining criminal proceeds with legitimate profits. Casinos, car parks, car washes, and salons are examples of businesses where there are few or no variable expenses. Fake invoicing, submitting fictitious invoices to match cash deposited, making it appear as if the money was paid in full for the false invoice. Smurfing technique is the practice of depositing tiny sums of money below the AML reporting level into bank accounts or credit cards, then utilizing them to pay bills and other obligations. Trusts and offshore businesses useful for concealing the true beneficial owners' identities. Foreign bank accounts, transferring tiny amounts of cash outside of the country, below the level of customs declaration, storing in foreign bank accounts, and then returning to the country of origin. Aborted transactions, funds are deposited in an accountant's or lawyer's client account with the expectation of completing a scheduled transaction. In a short period of time, the transaction is finalized. The funds are refunded to the client from a trustworthy source. Layering. Layering is the process of repeating placement and extraction with different amounts each time to make tracing transactions as difficult as possible. In simple terms, this entails the transfer of money from one location to another, or from one firm to another, with the goal of concealing the source of the money. Integration/extraction. The final step is to get the money out so that it can be used without drawing the notice of police enforcement or the IRS. Criminals are frequently content to pay payroll and other taxes to make the washing appear more legitimate in this aspect. Fake employees that aren't real, a chance to get your money back. Normally paid and collected in cash. Loans given to directors or shareholders and never returned. Dividends payments made to stockholders of criminally owned corporations.